Here's the economic update for July 4th. Happy 4th of July. For the jobs, on the 3rd of July, we added 147,000 jobs in the US. It's a little bit more than what we were expecting, but if you look back for the past 12 months averaged, it's in line with that, so it's not really that huge of a difference to me. Unemployment rate went down to 4.1%. It's been between 4 and 4.2% since May of last year, and it was at 3.4% in 2023. The people unemployed for more than 27 weeks increased by 190,000 people. That's now at 1.6 million. So it went down a little bit more last month. It went back to about the same number, so it's not anything that I'm panicking about. On July 1st, we had the JOLTS. So basically, we have 7.8 million open jobs, and we have about 7 million unemployed people. So that's about 1.1 jobs per unemployed person. Inflation, we got 27th of June. Our PCE, personal consumption expenditures, it's at 2.3%. It went down and came back up by 0.1. Again, nothing I'm really worried about. PCE core, similar, it's at 2.7%. So what the Fed wants is about 2% because the Fed has a dual mandate. So it still wants maximum employment, so it doesn't want to see this unemployment rate go up. And it wants stable prices, about 2% is what they target. So we're still a little bit high on what our inflation number is, and they like PCE core, so it's a little bit even more elevated. But we're not seeing the unemployment rate ticking up. So this is not giving them anything that's forcing them to drop their interest rates, and I'll get into that a little bit more. For our consumer confidence, 24th of June, basically it's declining. The expectation index is now at 69. Generally, when it's below 80, it's a recession signal, so both of these have been dropping. 27th of June, personal income has decreased by 109.6 billion. It's about 0.4%, not huge, but it is a decline, and you don't want to see your income go down. The disposable personal income also decreased by about 125 billion. Again, this is 0.6%. 27th of June, consumer spending decreased by $29.3 billion. And the big one is in vehicles and parts, also in gas and energy. So if I knew cars would go up in price in a matter of a month or two, why would I wait that time? So a lot of people, I think, bought cars a little earlier. That's why we had the spike in sales of vehicles. And then now that some of the tariffs are in effect, the vehicle sales have dropped off. So if you have a decrease in personal income and you have a decrease in disposable personal income, it doesn't surprise me that consumers then spent less money because they had less money to spend. And a lot of people tend to live paycheck to paycheck and don't have a lot of savings. When we look at our real gross domestic product, or GDP, on 26th of June, they revised this again. So originally it was minus 0.3, then they revised it up to minus 0.2. Basically that third estimate now is at minus 0.5%. It was downgraded further. And the main cause of this is, if you look at GDP, it comes in from consumer spending, investments, government spending. You have your exports minus your imports. And effectively for first quarter, everybody was trying to front load and purchase as many things before tariffs went into effect. So we have a massive amount of imports, and the government tried to spend less money, so then the government had a little bit less spending. Investments were a pretty strong positive, but still they weren't enough to offset the number of imports. On the 3rd of July, our most recent estimate for second quarter GDP, this is at positive 2.6%. I've been seeing this drop over the last couple of weeks, so I don't know if this is going to continue to drop or stay stable at this point. So only time will tell. Interest rates. If you look at July 3rd, our 30-year mortgage rate, basically mortgages, engages in death and pledge or grip. So I always find that funny. but it's about 6.67%. It's still relatively high compared to the last 20 years, but if you look back at the 1980s, it was like closer to like 15 to 18%. So historically, it's not huge, but it's enough to keep people from selling their homes because they would have to pay a lot more money than the 2 or 3% that they currently have their mortgage at. So that's preventing people from selling, and it's keeping a lot of buyers from buying as well. So on June 18th, the Fed basically held interest rates steady at 4.25% to 4.5%. There's some risk that they might fall behind, but there's more concern that if they drop interest rates too soon, that inflation can reheat and then they'll have to increase interest rates again. So that's the concern. That's the balance they're trying to figure out. And with really good job numbers, they're worried that if they start dropping the interest rate now with unemployment so low, that could lead to inflation. The other thing that they're worried about for inflation are some of the tariffs that are going to be going back into effect in the coming days. Housing. So 23rd of June, we're looking at a minus 0.7% year over year sales of existing homes. We have inventory growth. We're now at 4.6 months. So it's still somewhat of a seller's market, but it's starting to shift into the buyer's market, or at least more balanced. If you have 6 months supply, that's considered a balanced market. It's not a buyer's or a seller's market. Right now, we're still in a seller's market, but it is easing off and it's starting to shift to a buyer's market in some of the regions of the US. So right now we have positive 1.3% change year over year for median home prices. There is some contradictions that I'm looking at in the data from the Fed, and there's declines over the last couple of years ever so slightly. This is really regional. So if you look at the Northeast year over year, it's positive 4.2%. If you look out west, it's minus 6.7%. In the South, it's minus 0.5%. In the Midwest, it's positive 1%. I'm wondering with out west, like California, let's say, there are several tech layoffs that are taking hold right now. And with immigration enforcement and basically moving people out of the area, there may be less demand for housing in those cities and regions. So there's a couple of geopolitical things going on. So if you look at July 3rd, the U.S. imports from China are now at the lowest they've been since 2020 and 2009. Now, you could say, hey, that's great because more people will buy things from the United States. You could also say, well, if manufacturing has not ramped up in the U.S. because it takes years to get manufacturing sites up and running and hire people and train them and actually get the machines and everything going, you may have some, missing items at stores, or it may be harder to get certain things that would typically have been made in China. So this one's the biggest risk I see for next week. So on April 9th, we had the tariffs were paused for 90 days. That ends next week. That will be July 9th. And whatever tariffs are assigned at that point, those go into effect on August 1st. The other thing that we're looking out for is China basically had a 90-day pause a little bit after that. So effectively, we're looking at sometime in August to see what the agreement is between the U.S. and China. Progress has been made with China and the U.S. in that China is now allowing export of rare earth metals. These are needed for neodymium magnets and basically any electric motors and things like that. So that's good. It looks like there will be a 55% tariff on Chinese goods and a 10% tariff on U.S. goods going to China, but that's not finalized yet. In terms of the tariffs that were paused for 90 days, basically the U.S. is tariffing Vietnam 20%, and goods that go to Vietnam are at a lower rate. So if, say, China goes and tries to ship their materials to Vietnam and then to the US, those items will be tariffed at 40%. That's what I'm seeing right now, but it's changing. It's very fluid at the moment, so I'm not going to go through too many details. At the moment, I'm a little concerned because there's not actually a lot of negotiations that have been fruitful, let's say. Negotiations with Canada, one of the biggest trading partners with the US, and same with Mexico, they've basically stalled, so we're not getting anywhere at the moment. On 24th of June, we've had a ceasefire between the US, Iran, and Israel. So this is really good in terms of economics, because if Iran was at war with the US and Israel, what they could choose to do is block off the Strait of Hormuz. If they blocked off the Strait of Hormuz, basically that's 20% of the world's oil and liquefied natural gas supply. And you would basically relive the 1973 and 1979 periods where there were gas lines in the US and basically gas prices doubled overnight. So that's really good news, as well as, we don't want people dying for needless reasons. I am a little concerned with this, though, because the US is having a stance of they will not allow Iran to have a nuclear weapon or to enrich uranium past about 3.7%. And that's good enough for the production of electricity and things in the nuclear power plants, but it's not high enough for a weapon. Iran wants to basically go up to that 90% so that they can produce weapons. Taxes. On July 3rd, basically the House passed the big, beautiful bill. On July 4th, President Trump then signed into law basically the big, beautiful bill. It passed both the Senate and the House, and it already went through the president, so that's going to be made into law. This is pretty big in terms of tax cuts. That's going to end up stimulating the economy and potentially leading to inflation. Now, there are winners and losers whenever there's a change in law. If you're worried about this, ask yourself, do you pay taxes? Do you work? And if you can answer yes, you pay taxes, and yes, you work, this is going to benefit you most likely. If you do not work and you don't pay taxes and you're using public assistance, or if you're not a US citizen, this could be detrimental in terms of there's some cuts to Medicaid if you don't have like a social security number, if you're not a US citizen, if you're not working, those benefits may be cut. So if you're an able-bodied person that could go to work but you choose not to work, food stamps and Medicaid have a work requirement. If you're disabled, it seems like there's not a work requirement even in the bill. So I haven't seen all of the detail with it, but that's all coming out right now. So this also reduces taxes by about 3%, but it's not from today. It's basically all the tax cuts that were from 2017, the Tax Cuts and Jobs Act. They're made permanent now. So you won't see a tax hike, whereas if this wasn't passed, everybody would be paying 3% more if you're making above like $37,000. So like I said, this is going to benefit most of the people if you're working. So this also makes the child tax credit double effectively, because it was going to revert back to $1,000 per child. Depending if you look at the Senate version or the House version, it was going to be about $2,200 to $2,500. So it more than doubles the current child tax credit, at least for the next couple of years. And then after a couple of years, it's going to be just indexed to inflation. So it will continue to grow for people with kids. And that child tax credit, again, requires a social security number. So if somebody's not a US citizen, effectively it doesn't benefit them. It only benefits US citizens or people with social security numbers. On July 3rd, basically this has impacted the S&P 500. We're now at an all-time high once again. One of the concerns that I have is, being that there were some tariffs announced, if you look back to the US dollar versus, say, the euro, we're now at $1 is equal to about 0.85 euro. The US dollar has lost value. Mostly, it looks like, from the tariffs. We'll see how that goes, and next week might be a bit bumpy. Don't make any rash decisions. So what am I doing for next week? Well, I'm expecting volatility. Basically, if the tariffs do go into effect, I'm expecting the stock market to go down quite a bit, but it's also going to be offset some degree by the big, beautiful bill. And those tax cuts, basically, we're shifting how we collect taxes. The US is now going to collect more taxes from tariffs and less taxes from individuals and corporations. In the end, basically, the people that now have more money in your pocket, you get to choose whether or not you pay those tariffs when you purchase something by purchasing something outside the United States, which is tariffed, or you can choose to spend your money on things that are produced in the United States, and then at that point you're not paying the tariff because there's no tariffs on things made in the U.S. Now, that being said, if people import parts to then finally manufacture something in the US, and then that product would have some tariffs even though it was finally assembled in the US. So statistically, what I've seen is actively managed funds have effectively underperformed 90% of the time compared to somebody that just buys and holds, say, the S&P 500. Knowing that information, I'm still going to buy, a put option, a month or a couple of months out, and that way it gives me downside protection in case the stock market does go down. I have been increasing the amount of money I've been putting into the stock market. If I see a drop in stocks, I'm just going to buy more. So that's what I'm doing, but it doesn't really change my long-term investment plan. I have more than a 6-month emergency fund. I would advise people to have an emergency fund so that you're not panicking and dipping into something that goes down if it does go down. It also gives you peace of mind and keeps people calm through things like this. The other thing I'm doing is I'm still, investing 70-80% into the S&P 500, about 10 to 20% now into the international markets, and 5-10% into bonds. That's short-term bonds, I would say. And then I have a call option out for TLT, 20-year US bonds, but that's for 2027 for the options contract date. If you'd like to learn how to make more money, how to save, how to invest, how to be an entrepreneur, this is a channel for you. Thank you for watching. Please subscribe and have a great day.